Section 4.1 to 4.2 Understanding Short Selling, Short Covering and Exit Strategies. 4.1 Timing Short covering, understanding short squeezes and forced buy-ins is essential for anyone involved in short selling or trading stocks. Here's an explanation of these concepts. Short squeeze. A short squeeze occurs when there is a rapid and significant increase in the price of a stock that has a high level of short interest. It happens when short sellers, who have borrowed shares and sold them in the hopes of buying them back at a lower price, are forced to cover their positions by buying back the shares at a higher price due to a surge in demand. The increased buying pressure from short sellers closing their positions can create a feedback loop, driving the stock price even higher. Several factors can contribute to a short squeeze: positive news or catalysts. Positive news or unexpected events can trigger a surge in buying interest, causing short sellers to scramble to cover their positions. This can include strong earnings reports, positive product developments, regulatory approvals, or favorable industry news. Low float and high short interest. Stocks with a low float, limited number of shares available for trading, and a high level of short interest, large number of shares sold short, are more susceptible to short squeezes. With limited supply and high demand, it becomes challenging for short sellers to find shares to cover their positions, leading to further price increases. Coordinated buying or squeeze campaigns. In some cases, groups of traders or online communities may coordinate buying efforts to intentionally trigger a short squeeze and cause losses for short sellers. Margin calls and forced buying. If the price of a shorted stock increases significantly, short sellers may face margin calls from their brokers, requiring them to add additional collateral or close their positions. This can result in forced buying as short sellers rush to cover their positions, further fueling the upward price movement. Forced buy-ins. In certain situations, brokers or clearinghouses may initiate forced buy-ins to close out short positions that have not been properly covered by the short sellers. This typically occurs when the borrowed shares used for short selling are needed by the original owner or when there are concerns about the stability of the borrowing arrangement. When a forced buy-in is initiated, the broker or clearinghouse buys back the shares on behalf of the short seller, often at the prevailing market price. This can result in significant losses for the short seller, particularly if the stock price has risen substantially. Forced buy-ins are a risk faced by short sellers and are meant to ensure the proper functioning of the market and the timely return of borrowed shares. It's important for traders and short sellers to be aware of the potential risks associated with short squeezes and forced buy-ins. Managing risk through proper position sizing, setting stop-loss orders, and closely monitoring market conditions and short interest levels can help mitigate the impact of these events. Additionally, staying informed about the dynamics of the stocks being traded and closely monitoring news and market sentiment can provide valuable insights into potential short squeeze risks. Monitoring key levels and indicators for potential reversals is an important aspect of technical analysis and can help traders identify potential turning points in the price of a stock or other financial instrument. Here are some key levels and indicators to consider when monitoring for potential reversals. Support and resistance levels. Support levels are price levels where buying interest is expected to be strong enough to prevent further price declines. Resistance levels are price levels where selling pressure is expected to be strong enough to prevent further price increases. Monitoring the price's behavior around these levels can provide insights into potential reversals. A break below a support level or a break above a resistance level may indicate a potential reversal. Trend lines. Trend lines are lines drawn on a price chart that connect significant highs or lows. They help visualize the direction and strength of the prevailing trend. Monitoring the price's interaction with trend lines can provide indications of potential trend reversals. A break of a trend line can suggest a shift in the trend direction. Candlestick patterns. Candlestick patterns are graphical representations of price movements that can provide insights into market sentiment and potential reversals. Patterns such as doji, hammer, engulfing, and evening/morning star can signal potential reversals. Traders often use these patterns in conjunction with other indicators to confirm potential reversals. Overbought and oversold indicators. Indicators like the Relative Strength Index, RSI, and Stochastic Oscillator can help identify overbought and oversold conditions in the market. When these indicators reach extreme levels, it may suggest that the price is due for a reversal. Traders watch for divergences between price and these indicators, as they can provide early signals of a potential reversal. Volume analysis. Monitoring trading volume can provide insights into the strength and sustainability of price movements. An increase in volume during a price decline or a decrease in volume during a price increase may indicate a potential reversal. It suggests a shift in market participation and can be a signal of a change in trend. Moving averages. Moving averages smooth out price data and help identify trends. When a shorter-term moving average crosses above or below a longer-term moving average, it can signal a potential reversal. For example, a bullish crossover occurs when a shorter-term moving average crosses above a longer-term moving average, indicating a potential shift from a downtrend to an uptrend. Divergence. Divergence occurs when the price and an indicator move in opposite directions. For example, if the price makes a new high, but the indicator fails to make a new high and instead starts to decline, it may indicate a potential reversal. Divergence can provide early signals of a shift in momentum. It's important to note that no single indicator or level can guarantee a reversal. It's best to use a combination of these tools and indicators, considering the overall market context and other factors, to increase the probability of identifying potential reversals. It's also recommended to practice proper risk management, including the use of stop-loss orders, to limit potential losses if a reversal does not occur as expected. Assessing profit targets and risk-reward ratios is an important aspect of trading and investing. It involves evaluating the potential profit potential of a trade or investment relative to the potential risk involved. Here are some key considerations when assessing profit targets and risk-reward ratios. Identify potential price targets. Determine potential price targets based on your analysis and trading strategy. This can include technical levels, such as support and resistance levels, trendline projections, or chart patterns. Fundamental factors, such as earnings expectations or industry trends, can also help identify potential price targets. Set realistic and achievable price targets based on the timeframe and volatility of the market. Set profit targets. Once you have identified potential price targets, set profit targets accordingly. These are the levels at which you plan to exit your position and lock in profits. Consider setting multiple profit targets, such as taking partial profits at different levels, to manage risk and maximize potential returns. Adjust your profit targets based on changing market conditions or new information that may affect the trade. Evaluate risk-reward ratio. Assess the potential risk and reward of the trade by calculating the risk-reward ratio. This ratio compares the potential profit of a trade to the potential loss. A favorable risk-reward ratio indicates that the potential reward is greater than the potential risk, making the trade more attractive. Typically, traders aim for a risk-reward ratio of at least 1 to 2 or higher, meaning that the potential reward is at least twice the potential risk. Consider probability of success. Assess the probability of the trade reaching your profit targets based on your analysis and market conditions. Evaluate factors such as the strength of the trend, the volatility of the market, and the quality of your trade setup. A higher probability of success increases the attractiveness of the trade and may allow you to set more aggressive profit targets. Adjust profit targets and risk-reward ratio. Regularly reassess your profit targets and risk-reward ratio as the trade progresses and new information becomes available. Consider scaling out of the position or trailing stop-loss orders as the price moves in your favor to protect profits and manage risk. Be flexible and adapt your profit targets and risk-reward ratio based on changing market dynamics. Risk management. Implement effective risk management strategies to protect against potential losses. Set stop-loss orders to limit losses if the trade moves against your expectations. Consider position sizing based on your risk tolerance and the potential risk of the trade. Adjust your position size to maintain a consistent risk-reward profile across different trades. Evaluate market conditions. Take into account the overall market conditions, volatility, and liquidity when setting profit targets and assessing risk-reward ratios. Different market environments may warrant different approaches. In highly volatile markets, profit targets may need to be adjusted to account for increased price swings and potential slippage. Remember that assessing profit targets and risk-reward ratios is not an exact science and involves a degree of judgment and experience. It's important to continually refine and adjust your approach based on your trading style, risk tolerance, and market conditions. Regularly review your trades to assess the effectiveness of your profit targets and risk-reward ratios and make any necessary adjustments to improve your trading strategy. 4.2 Exiting short positions. Scaling out of positions is a strategy that involves gradually reducing the size of a position as it moves in your favor. This approach allows you to take partial profits while still maintaining exposure to potential further gains. Here are some common strategies for scaling out of positions. Percentage-based scaling. With this approach, you set predetermined profit targets as a percentage of your overall position. For example, you may decide to sell 25% of your position when it reaches a certain profit level, then another 25% at a higher profit level, and so on. This strategy ensures that you lock in profits as the price moves in your favor while still leaving a portion of your position open for potential further gains. Price-based scaling. With this strategy, you set profit targets based on specific price levels or technical indicators. For example, you may decide to sell a portion of your position when the price reaches a key resistance level or a predetermined price target. This approach allows you to capitalize on price levels that are expected to act as significant barriers to further price appreciation. Trailing stop loss. A trailing stop loss is an order that adjusts dynamically as the price moves in your favor. Instead of setting a fixed price for your stop loss, you set a trailing percentage or dollar amount. As the price increases, the stop loss level automatically adjusts to lock in profits while still allowing for potential upside. This strategy allows you to participate in further price gains while protecting your profits if the price reverses. Time-based scaling. This approach involves scaling out of positions over a predetermined time period rather than based on price or profit targets. For example, you may decide to sell a certain percentage of your position at regular intervals, such as every week or month, regardless of the price movement. This strategy helps manage the emotional aspect of trading and ensures that you systematically take profits over time. Fundamental catalysts. If there are specific fundamental catalysts or news events that are expected to impact the stock price, you can consider scaling out of your position before or after the event. For example, you may decide to reduce your position ahead of an earnings report or a regulatory announcement. This strategy allows you to capitalize on anticipated price volatility surrounding these events. It's important to note that scaling out of positions is a personal preference and depends on your trading style, risk tolerance, and market conditions. The chosen strategy should align with your overall trading plan and objectives. Regularly review and adjust your scaling strategy based on the evolving market conditions and the performance of your positions. Trailing stop orders and profit-taking techniques are commonly used by traders to manage their positions and secure profits. Here's an explanation of each strategy. Trailing stop orders. A trailing stop order is a type of order that adjusts dynamically as the price of an asset moves in a favorable direction. It is designed to protect profits and limit potential losses by automatically adjusting the stop price. Trailing stop loss. When using a trailing stop loss order, the stop price is set at a certain percentage or dollar amount below the current market price. As the price rises, the stop price is adjusted upward, maintaining a fixed offset from the highest price reached. If the price reverses and reaches the stop price, the order is triggered, and the position is automatically sold, limiting the potential loss. Trailing stop limit. This type of trailing stop order combines a trailing stop with a limit order. It allows traders to specify both a trailing stop percentage or dollar amount and a limit price. When the trailing stop price is reached, the order becomes a limit order with the specified limit price. If the market reaches the limit price, the order is executed at that price or better. Trailing stop orders provide a way to lock in profits as the price moves in your favor, while still allowing for further upside potential. They eliminate the need for manual adjustments to stop levels and can be especially useful in volatile markets. Profit-taking techniques. Profit-taking techniques involve exiting a position or taking partial profits when specific profit targets are reached. Here are a few commonly used techniques. Scaling out. Scaling out involves gradually reducing the size of a position as it moves in your favor. It allows you to take partial profits while still maintaining exposure to potential further gains. This technique can be implemented using percentage-based scaling or price-based scaling. As mentioned in the previous response. Price targets. Setting specific price targets based on technical levels or fundamental analysis can be an effective way to determine when to take profits. These targets can be based on key resistance levels, trend lines, Fibonacci retracement levels, or other technical indicators. When the price reaches your predetermined target, you close the position or take a portion of profits, time-based profit taking. Another approach is to set a specific time horizon for a trade or investment and take profits when that time expires. This technique is useful for short-term traders or those with a defined trading plan. It helps to avoid overtrading and ensures that profits are locked in within a specified time frame. Fundamental catalysts. If there are specific fundamental events or news releases that could impact the stock or market, you may choose to take profits before or after such events. This technique allows you to capitalize on anticipated price volatility and manage the risk associated with potential adverse developments. It's important to consider your trading style, risk tolerance, and overall trading plan when deciding which profit-taking technique to use. Regularly review and adjust your profit targets and trailing stop levels based on market conditions, price movement, and new information that may affect your positions. Managing emotions and sticking to a trading plan are crucial for long-term success in trading. Here are some strategies to help you manage emotions and stay disciplined. Define a trading plan. Develop a comprehensive trading plan that includes your trading strategy, risk management rules, entry and exit criteria, and profit targets. Having a well-defined plan helps you stay focused and provides a framework for decision-making. Regularly review and update your trading plan as needed. Set realistic expectations. Understand that trading involves both winning and losing trades. Set realistic expectations and avoid chasing unrealistic returns. Accept that losses are a part of trading and focus on long-term profitability rather than short-term gains. Follow risk management principles. Implement proper risk management techniques to protect your capital. This includes setting stop-loss orders to limit losses, managing position sizes based on your risk tolerance, and diversifying your portfolio. Adhering to risk management principles can help you mitigate emotional decision-making driven by fear or greed. Use technology and automation. Utilize technology and trading platforms that allow you to set automated orders, such as stop-loss orders and profit targets. This reduces the need for constant monitoring and helps you stick to your trading plan without emotional interference. Practice patience and discipline. Stay patient and disciplined in your trading approach. Avoid impulsive decisions driven by short-term market fluctuations or emotional reactions. Stick to your trading plan and only take trades that meet your predefined criteria. Keep a trading journal. Maintain a trading journal to record your trades, including entry and exit points, reasons for entering the trade, and emotions experienced during the trade. Regularly review your journal to analyze your trading patterns, identify areas for improvement, and learn from both successful and unsuccessful trades. Seek support and education. Connect with other traders, join trading communities, or seek professional guidance to gain support and learn from experienced traders. Engaging in ongoing education and seeking different perspectives can help you manage emotions and gain insights into effective trading strategies. Control emotions through mindfulness. Practice mindfulness techniques to manage your emotions while trading. This involves being aware of your thoughts and emotions and learning to detach from them. Techniques such as deep breathing, meditation, and visualization can help you stay calm and focused during volatile market conditions. Remember, managing emotions and sticking to your trading plan requires self-discipline and continuous effort. It's essential to be aware of your emotions, develop strategies to manage them, and consistently apply them in your trading activities. By maintaining discipline and following your trading plan, you increase the likelihood of making objective decisions and achieving long-term success in trading.